Welcome to Market Index and Livewise C-Suite coverage. I'm Carl Capilingua, and today I have the pleasure of chatting with the CEO of Australia's newest uranium producer, Boss Energy's Duncan Craib. Duncan, thanks for joining us.
Carl, thanks very much for having me on your show. Thank you. And for all the analytical coverage over the past few years. It's been terrific.
Absolute pleasure. It's been a pleasure to track the company's journey over that time. Certainly been covering uranium very closely for the last couple of years of this part of the cycle. And as I've been writing about Boss Energy, it's been, production's X number of years out, to 6 months out, till we're here. And now really we've just finished your first full 6 months of production. So congratulations on becoming a uranium producer. How does it feel? And maybe you could give our readers a bit of an idea of some of the challenges that the company faced to get here.
Sure. It's been a long journey. So in some ways it's sort of success overnight, but really 8 years in the making with Boss Energy. We've had to really survive with a low commodity price for many years and sort of walk in tandem with the market. Almost, I sort of refer to it as campaign style. We were raising funds when there was interest in the market and then doing new exploration or feasibility studies, all the while sort of focusing on building the foundations of the company with a view that Boss Energy's Honeymoon mine would go into production. So yeah, taking that final investment decision back in June 22 was a big step, and just delighted to actually, some 2.5 years later, be producing uranium and earning a profit. It's great.
Yeah, well, as I said, congratulations on that journey, because if we think about just small, mining companies, ASX listed mining companies in general, there might be 1,000, and I don't know what the statistics are, but there might be a dozen of those 1,000 that actually make it through to production. What do you think maybe set you apart from so many others that failed?
It is tough in Australia for small companies. Really, you have to find the right technical expertise to help you on that journey. It's challenging. You're competing with the majors who often have that talent in-house. So really aligning yourselves with good professionals to help you with that mine build's essential. And also finding good stakeholders and shareholders that actually see the long journey and want to support the company through that development phase. So yeah, it's a mixture. And of course, underlying all of that, you've got your stakeholder support within your traditional owners, which is very important in Australia, as to the government. And we're very fortunate with both our stakeholders, the Willakali, Agnomantha, Ngātri Nation, and also the state government of South Australia, who've been very supportive in helping us in this journey. So yeah, a lot of the success is down to them supporting us. And, I'm hoping now that we get to repay that sort of gesture of goodwill with paying taxes and royalties, etc.
Yeah. Well, you mentioned confidence through the cycle, and there probably aren't many other commodities apart from uranium that cycle so viciously over the years. And obviously there were mitigating circumstances on that last cycle with respect to the Fukushima disaster. And you say that, it's great to repay, I guess, everybody kept faith through when uranium prices were, down in the teens and the 20s. Now that you're a producer, it's different from when you're an explorer. The price of the commodity matters now, right? It's a major part of your total shareholder return equation. We know it cycles. What are your views on the current uranium pricing environment, and perhaps where do you see or how this is going to
develop? Sure. It absolutely fundamental to the success of the project. So, there's some arguments out there as to when is the right time to optimize or actually extract that resource from the ground and monetize it. It's a real challenge, really. Our view is that the price is going up, and we're bullish about that. And the reason why is that the supply-demand deficit continues to widen. So new mines are needed. But for those new mines to come into production, a higher incentivized price is required. So currently the long-term price that we look at, the term price, is around $80 per pound. It's trading higher than the spot price, which is typical if you look at the sort of historical tracking of spot versus term price. So it's in a good place. And that term price really over the 2024 rose consecutively every month. So the term price is moving up. Now, it's deemed to be between 90 to 100 US a pound that's required to start incentivizing new projects. So if you're a new development mine, you're yet to raise your capex through equity or finance, the financial part of that, the debt part of that, is often underpinned by entering into forward contracts. Now, contracts are a little bit technical. Contracts now have a floor and a ceiling, more market related, but the banks will only take into account the floor price. So that's what inhibits companies going into production at the moment, new development projects. So, for example, if you've got a term price of 80 US a pound, which it is, then you're probably looking at a floor of around 70, 75, a ceiling of, call it 110, 115. The bankers will only look at that floor price of 70, 75. So a lot of companies or development projects can't get up at this point. Now, the longer those companies don't come into production, that deficit continues to widen, and it's going to lead to a pop in the commodity price.
In many ways, this concept of an incentive price actually works in Boss Energy's favour, given you're already producing.
It works in our favour because we're a lower cost producer. In situ recovery mines were the ones that actually stayed in production predominantly and had the market share during those years that the commodity price was in the doldrums, post-Fukushima. Because they're a lower cost producer, it does away with open pit, yellow fleet, all the personnel required in digging a large sort of hole in the ground. It's an easier process to manage from a mining cost perspective.
Just on this term price and spot price, I find this quite fascinating. I find in my experience as an analyst that investors can be quite short-term in their focus, and they do tend to focus more on the spot price, which is coming down. I mean, it's come down from 110 to, as you say, 60s now. Maybe you covered it a little bit, but just re-emphasise for us why investors should focus on the term price and not that spot price, or how long until they need to start focusing on the spot price.
Sure, I can understand why they focus on the spot price because it's quoted daily. One can easily see it from many platforms of sort of industry analysts that cover the price. But the spot market's very illiquid. It's not where 10% of sort of uranium that's traded is through the spot market. The majority is actually through term contracts. So we as a producer look at the term pricing, and term pricing really only gets sort of shown to the market or publicised once a month. So I can understand if, as a bit like a barometer, if spot's going up and down and volatility, often the sort of retail or just general investors follow that and think, oh gosh, suddenly spot's fallen. But all sorts of movements occur. You might notice at month end, there's often a dip in the spot price because typically earlier in the next month, the term contracts land. So delivery of material occurs and it's the prevailing spot price at that time of which the contractual parties pay or assign that monetary value to the payment. So yeah, it's a challenge. Unfortunately, term price isn't quoted more frequently. I guess for us, I hope as investors, and I'm noticing there is a change, I'm noticing that more analysts, particularly funds, are taking more time to actually learn about the term price and see that. And as mentioned, it's typical for the term price to be at a premium to the spot price because effectively the producer's being paid a premium to forward contract that sale. So you do deserve a bit of additional profit.
Great. I really appreciate that explanation for our readers. Look, our readers, I think, are quite familiar with Boss Energy. We cover it extensively across our Market Index and Livewire platforms.
Thank you. Yeah.
But, and probably very familiar with the Honeymoon project, but I reckon they're a little bit less familiar with Alta Mesa, given it's relatively new. Perhaps you could tell us a little bit more about that project, how it's progressing and its strategic importance.
Sure. So Alta Mesa is effectively run by a company, US-based company called Encore Energy. And behind Encore Energy, the chairman, Bill Sharif, and also Paul Goringson as the CEO. And they've got a very experienced board, but we've had touch points, and I know those gentlemen for many years, as to our board members do. They're stalwarts within the industry. Paul Goringson and Bill have both been through several cycles, and arguably I think Paul and his technical team are the best ISR operators in the US. So we fondly look towards them for advice, and likewise in terms of how we're approaching in situ recovery mining, how we're looking at ion exchange. So a lot of intel has been shared and sort of camaraderie within the industry over the years. So for us, the social synergies are there. It was then looking at how can Boss grow, and we're really focused on tier one jurisdictions. So for example, Australia, the US and Canada broadly, but then states within those jurisdictions. And Encore's had Alta Mesa, which we think is one of the best ISR projects in the US, based in South Texas. And it was of great appeal to us. And over the journey, just talking it through, Encore were looking for some partnership. And we thought that would be a good stepping stone into sort of M&A type activities. So yeah, it's proving to be really worthwhile. We get on, fabulously well, and the project itself is now producing and shipping uranium. So good investment, but a long-term investment. So again, we're trying to get in at the beginning of the cycle with that first mover advantage.
Yeah, happy with 30%?
I'm happy with 30%. We actually wanted to get a bit more at the beginning. Unfortunately, that was when the uranium price really started to move. So when we started negotiations, it was around 65, 70 US per pound. By the time we signed, it was around 105. So
yeah, makes it a little bit more difficult.
A bit more difficult, yeah. And that's as you mentioned, like the volatility of the price does sort of impact not operations, but also those sorts of discussions.
Yeah. Maybe we're circling back again on the uranium price, but there's also this 1.25 million pound strategic inventory that you call it. You got in pretty much at the bottom of the cycle. We've just talked about how high we got to in that last move. Is it fair to say, you mentioned you're bullish, is it fair to say that as long as you're holding that, that's still the case? What are the plans?
No, sure, because we do see great value in that holding. When we purchased the 1.25 million, the spot price, or what we paid for it, was 30.15 US per pound. So it's been a really good financial investment. But we also did it for strategic reasons. One is it sort of underwrites or guarantees our ability to contract with utilities. So they're guaranteed that if there is a problem with our ramp up, then they can draw down on that physical. Fortunately, there haven't been any problems, as we announced in our quarterly. The other aspect was really to provide working capital requirements for, not many know this, or it's not well publicised, but typically for a uranium producer, you retain ownership of that product from when it leaves your mine gate until it's shipped and accepted by the conversion facility. So we're shipping product, say, to Europe, to France, or to the US. It's only once the conversion facility accepts that product does ownership pass to the utility. So that logistical period of shipping, sometimes 3 months or 4 months, if there's any hiccups to that, you don't want to be caught short without the material. You don't want to have to go to the market and buy material to honour your contract. So typically it's healthy to have a buffer of inventory.
Yeah, look, a couple of things. I want to talk about the quarterly in a second, but you mentioned countries, obviously, supplying to the converters. So
sure.
Countries in Europe, you mentioned France, US. I noticed you didn't mention one country in particular in that sentence, Russia, obviously. And there's such a strategic environment at the moment in this industry in particular. Obviously, you're producing out of Australia, which is no mean feat in itself. You're hoping to produce in the US as well. Maybe you could just give us a quick general commentary on where you see the uranium market from a strategic
sure.
geopolitical perspective.
Sure. When Russia invaded Ukraine, it sent shockwaves through the industry, particularly through Western fuel buyers and utilities. I mean, Russia's impact, it's been extensive, and particularly shaking the confidence really in sourcing material or uranium or enriched material from Russia or Kazakhstan. Kazakhstan's a landlocked country, so most of its material has been shipped through St. Petersburg. Sanctions were then applied, and it became difficult for Kazatomprom to ship that material to the Western world. So fuel buyers, it's not, you need uranium, you need your own stockpiles. You can't simply turn a uranium plant on or a nuclear plant on or off. So they then started the psyche shift, and they're now looking for more Western suppliers. So whether it's parts of Africa or Australia or US or Canada, where's that Western supply going to come from? And yeah, fortuitously, it works for Honeymoon. So what we're finding is that the Eastern Bloc is sort of now China and Russia are taking a greater interest in uranium mines within Kazakhstan and sort of cornering that market. For China, it's probably a good result or a healthy result because they've got a huge nuclear growth program and now their neighbouring country, which by sort of culture, they want to diversify their client base and not be dependent on one customer. Now they're really feeding China as their primary customer, and to the detriment of being able to sell to the US and Europe. And that's where we can come in and fill that demand.
Yeah, so I think it's important for investors to understand that there's this two-tier market in uranium where we're always hearing about this latent supply that can be turned on from the two biggest producers, Kazatomprom and Cameco. But really, some of that is locked out effectively, and it leaves other producers such as yourself who are producing in these safe and trusted jurisdictions to almost run a different race. Maybe circling back to that term price, I guess, how does that benefit you there?
Yeah, I guess, no, you're right. I think that a lot of the, even with those mines developing or further developing in Kazakhstan, for example, there's still a deficit of supply. Like, new supply is needed around the world. So I think, yeah, we're in a fortuitous position with that regard. The term price, there's still one term price and spot price that the world looks to. What we don't really want to see in the industry is a bifurcated market where there may be pricing in the Eastern Bloc and pricing in the Western Bloc. There's no mention of that at the moment, but I often think about it and wonder what would happen. But at the moment, it is still a global market with those prices being quoted that we all adopt. So just to sort of help explain, when we, for example, enter into a market-related contract, so a floor and a ceiling, it's predicated initially negotiating with that term price, and you have, say, a 15% discount to a floor or 30% premium to a ceiling. When you actually then deliver the product, say in a year's time or 2 years' time, it's the prevailing spot price at that time. And so long as it fits within the floor and the ceiling, that's the price that you receive.
Okay.
Yeah.
Fantastic. Let's circle back to the quarterly, better get down to some nuts and bolts here. And, you know, I read several analysts' reports about the quarterly. I read it myself. And unfortunately, as an interviewer, I couldn't really find anything curly to hit you with. It was a relatively clean sheet, particularly on costs. You beat the market substantially on costs. You could say that was a great performance, or maybe the market had it wrong in terms of what they were assuming. So why did the market get it wrong? And in an industry where costs are such a big problem, why are you doing so well, and can it stay that way?
Yeah, so we believe it can stay that way. It's again a virtue of in situ recovery being a cheaper method of mining. Our ion exchange processing plant that we've now incorporated into the processing circuit does allow us to increase our production throughput and lower cost of production. So we are going well in that regard. I hope it stays that way. We're certainly, that's the name of the game, really. Now build more efficiencies into the plant and try and minimise costs where we can. It's not without its challenges sometimes. I mean, it is getting your mine up and running is difficult. So we did deliberately take our time to make sure that we fully understand the costs that were incurred before we publicise them. And I think that's the prudent approach. I think sometimes, I've been here before, sometimes companies are too brash or come out very quickly with their cost of production before they really understand it. So we deliberately really wanted to understand our mine. But because of that delay and time, some people in the market took a view, oh gosh, they're hiding something or they're worried. Others thought, oh, here's an opportunity, and they filled their boots, so to speak. Yeah. Particularly our long-term shareholders. So I'm thrilled for them. But yeah, it's also, it is a tough industry. I think some of those that have gone before us have struggled in those early years, and it's probably a nature of not a sort of a lack of talent in the industry. I think post-Fukushima, for example, a lot of talent left the industry to go into more sort of exciting commodities, whether it be gold or lithium or zinc or copper or whatnot. So with that industry experience leaving, there are not many people around, but the good news is they're coming back. So yeah, I think I really do feel that we're on the cusp of a new cycle, a bull cycle, and I think a lot of talent's now coming back, and a lot of youth is now entering the industry, which is particularly pleasing to see.
Just looking out to the next 6 months for the full year, really, how is the ramp up going? Are there any challenges you're foreseeing? How are you dealing with those? We're kind of, is it fair to say, halfway through this wide arc?
I think our next big sort of finishing the CapEx, finishing the mine build, our strategy was always start producing even though we're finishing off the front end of construction. So there are 3 more columns to actually install and commission. They're lying down in the laydown area on site. They're ready to be installed. So that happens over the next 6 months. And then you really switch your focus on to becoming more a wellfield development company. We just keep developing wellfields and incorporating them. We're also bringing in our satellite deposits. So we've got an independent geological consultants doing that assessment. That'll be ready by Q3 this year. So yeah, some really nice sort of milestones to aim for, but there's no doubt the pressure's still on. We're not through it yet. We are still commissioning, and I think we're doing a good job. But yeah, it's hot on site. It's been summer. I mean, temperatures get up to the high 40s, sometimes touching 50. So full credit to the team on site. They work hard. They're in the outback. They're about 80 kilometres northwest of Broken Hill as the crow flies, and they're really doing a good job. Yeah,
look, I've been covering mining companies for 20 years, Duncan, and I can probably count on this one hand how many development projects have gone as smoothly as yours. So definitely credit deserved there.
Yeah, no, the guys are doing a great job.
Looking to the future, you're producing, you're profitable, you're sitting on a pile of cash, you've got no debt. How do you intend to leverage this great position the company's in and acquisitions? In the offing? You mentioned some of those quote unquote more exciting minerals out there, or is it always going to be a one commodity?
I think we should stick or really focus on uranium. I think that's our niche in the market. Being an Australian focused uranium company too. In fact, being a multi-mine producer right now, we're the only multi-mine producer on the ASX. But our cash position, really our liquid asset position with our stockpile of inventory is healthy. It's about $250 million. It's just when do you monetize that strategic inventory? And we fundamentally believe that the uranium price is going to lift higher. So it almost seems to sell that down now isn't advantageous. But we have always been looking at opportunities in the M&A space, as well as organically growing on our own tenements and through exploration. But yeah, it's really finding the right time and the right project to go for. I've mentioned sort of sticking with tier 1 countries, but it's also the life cycle. Whether if you go for a grassroots sort of exploration play, you're looking at a 8 to 10 year period to bring that into production on average, possibly longer. If you go for more advanced development or near-term producer or actual in-producer, then you've got that immediate cash flow benefit. So yeah, quite a lot to consider, but we've got a really good team, and I think one of the sort of enjoying, satisfying parts of Honeymoon's development was having a team that self-performed. So we didn't go down the EPCM option and outsource all of our mine build. We actually built our own engineering team and designers and contractors to get that up and running. So if we can apply or harness that talent to then put it to a new project, that would be first prize. But for the time being, Honeymoon's our focus. Let's get our flagship right.
Well, a very exciting time clearly at Boss Energy, and no doubt our readers at Market Index and Livewire will be watching very closely. Duncan Craib, thanks so much for joining us today.
Terrific. Thanks very much, Carl. Thank you.